Hello everyone, my name is Michael Valtos, and today I'll be talking about how order flow will improve your trading. So today, what I want to talk about, first, I think you're going to be in for a treat. If you're not familiar with order flow, I think after today's presentation, you will be much more comfortable looking at an order flow chart. And I'm going to show you the easiest way to understand what's happening in the market so you can make better trading decisions tomorrow if you so wish to use order flow. Now, my goal today is basically determine if order flow trading is for you. It's not for everybody. And if you're a short-term trader, it's going to really turbocharge your trading. If you're more of a long-term swing trader, trading, positions that last for a week or a month, order flow is probably not for you. I just want to get that out there and rather than have you go through, hours and hours of training to realize it's not for you. It's really more designed for shorter-term trading, intraday trading. And I'm going to show you how to read order flow to find market-generated levels to trade around, how to use order flow to determine whether highs or lows will hold or break. Every time you get up to a high for the day or a low of the day, you want to be asking, is this high going to hold, or is this low going to hold? I'm not really trying to pick highs or lows, but I want to know, are we going to keep going higher, or is it possible we can reverse right here? And I'm going to show you a simple order flow trick to determine, potential trend days early, and I'm going to talk about some order flow tools to help you uncover high probability short-term trades. And I'm going to do it without saying you need tons of screen time. People like to think that, oh, I got to have 10,000 hours of screen time. Who has 10,000 hours to devote to learning how to trade? That's a full-time job for how many years? I don't think you necessarily need fancy indicators. Like the previous presenter Steve was saying, keep it simple, right? No messy charts. And I'm going to teach you how to trade as a trader, right? If you follow indicators, you're not necessarily trading. You're just a trade follower. Trading is about making decisions, and that's what I'm going to show you. And if you stick around to the end, I got a special treat for everybody. It's my 150-page book that I wrote a couple years ago. It's called Trading Order Flow. It's only been available to users of my software and people that have paid me a lot of money for it. With special training. But for today, I'm going to, if you stick around to the end, I'll give you directions on how to get that for free. Now, if there's one thing we can all agree on that we hate about trading, that is it's risk, right? Nobody likes to take extra risk. I mean, I don't. There's no reason why anybody should be taking extra risk. I don't want you to take extra risks in your trading. I see risk and I run, plain and simple. And, order flow is going to help you reduce the risk in your trading. So, the first question you have to ask, I'm sure everybody here is familiar, has traded. There's probably a few people here that, maybe relatively new to trading. And, one of the things that you have to ask, is trading for you? Are you willing to take action? Do you want to be your own boss? In trading, there's no regular paycheck. You could go days, weeks, months losing money, right? Can you handle the rejection? Losing money affects your psychology. Once you start internalizing and putting money into other terms, like thinking, oh, I just lost, $1,000. I could have taken the wife and kids to Disneyland for the weekend. It affects you mentally, and you have to take that into account. If trading is for you, and I do think order flow will help people understand the market and become better traders and want to take their trading to the next level. So briefly about myself. Okay, I've been in the futures markets for 20 years. At what I think is about as high as you can go. I was a futures trader at JP Morgan for 8 years, Commerzbank, the big German bank, for 3 years, Cargill for 4 years, EDF Man for 2 years. I started on the trading floor at the CME. This is me, in different places. This is Hong Kong. Here is me with my family, my wife, and I got 3 kids. Dubai, Singapore. And trading has given me the freedom to travel around the world. Well, I started my family after I got out of JP Morgan, but it's given me that freedom to have a full life, rather than necessarily being a slave to a 9-to-5 job, or just basically being tied down to a desk. When I left JP Morgan, I was 43 years old, and I'm sure everybody would like to say they retire at 40, in their 40s, but in this economy nowadays, it's not always easy. And I'm trying to make this about me short, because it's not going to be about me, it's about you, right? I want to show you how order flow analysis will help your trading in the least amount of time possible. But first, I got to go through this brief disclaimer. This presentation is for educational and informational purposes only, and is not considered a solicitation to buy or sell a futures contract or make any other type of investment decision. I'm not going to say, oh, join the so-and-so brokers. No, I'm not going to do that. That's a decision you have to make on yourself. Futures trading contains substantial risk, and it's not for every investor. An investor could potentially lose all or more than the initial investment. Risk capital is money that could be lost without jeopardizing your financial security or lifestyle. Risk capital should be used for trading, and only those with sufficient risk capital should consider trading. Past performance is not necessarily indicative of future results. There's a reason, the government has you say that, because, don't come into trading thinking, hey, this is the road to easy street. It's not. There's a lot of traders out there that are break even. There's a lot that grind, a lot that just barely break even, that are happy to make $100,000 a year trading. Don't think it's all, supermodels and jets and fast cars. It's not, but if you're consistent, you could make a very good good living. But don't come in like, thinking, hey, this is it, in a week I'm going to be driving a new Ferrari. Chances are you're not. So why do most traders fail? Well, there's a lot of reasons, but personally I think the three main reasons: one, they don't understand the market, plain and simple; two, they take on too much risk, they're highly leveraged; and three, they spend too much time learning and not enough time doing. Being a successful trader is about taking action. Just about anything in life, you have to take action. You could go watch all the webinars, all the videos. I've got how many? I don't know, I got about 100 videos up on YouTube about trading. You could spend all day long watching every video out there, but until you actually start trading, that's really going to be the best experience. I'm not saying go out tomorrow and open up an account, but if you're staying in SIB mode for 10 years, chances are you're not going to be a very successful trader. Put it in reality. Okay, again, don't come in here thinking you're going to be driving around, fancy car, you're getting on your private jet. For a lot of people, the image is the one with the gun to the head. You take a trade, it's immediately against you, and you're questioning your existence. Should you be trading? And so ask yourself, is this really what you want to do? Again, I want to put it out there. I'm not trying to discourage people, but there's money involved, right? I hate to lose money. I'm not somebody that can go to Las Vegas and say, oh, what? If I lose $5,000 this weekend, that's okay. It's entertainment. No, there's 1,000 other ways I could spend $5,000 for entertainment, and you have to approach trading as a business, not as recreation. And order flow will help you break down the market so you understand what it is that you're looking at. So again, I want to show you how to use order flow to make your market analysis easier and simpler. So do you want to see how? I'm sure you do if you stuck around to here. Now, order flow is going to make it easy to find hidden strength and weakness in the market, how to determine if highs or lows are going to hold, and see market-generated support or resistance levels. Now, this knowledge, right? It's not some hidden dark art. It's available in the data. Whether you look at it or not is up to you. If you're looking at a normal bar or candlestick chart, you're not going to see this information. You're only going to see it on an order flow-generated volume footprint chart. And this is how it looks like. Okay. At first glance, it looks intimidating. There's a lot of numbers. I know people are scared of numbers. People don't like math, and they think I got to do all these calculations. No, it's not like that at all. It's the complete opposite. There's three main things which I'll discuss today for order flow. The building blocks, so to speak, of order flow. The point of control, delta, and imbalance. Now, there's many other aspects of order flow, but there's only a certain amount of time, and I need to sort of keep it together. But breaking it down: point of control, delta, and imbalance. Those three concepts, once you understand them, really helps you understand and see what's happening in the market. So first one is point of control, POC. People say POC, or they'll say point of control, and what it is, it's the level in a bar with the most volume. And on an order flow chart, as you can see here, it's going to be highlighted with a box around the price level. And what it means to you, well, it's a market-generated support or resistance level. The market's telling you, hey, there was support here or resistance there. Now, oftentimes, it's not very clear, but sometimes it just really sticks out. But on an order flow chart, it has a box around it, so you can easily identify it. Now, do you think volume is important? It is, okay? Not all prices are equal, right? Whether you trade one lot at a certain price or you trade 5,000 lots at that same price, which do you think, has more value to it? I want to say more value, but, which is more important, the one lot that you traded or the 5,000 lots that you traded? So, it's that information you can take and process and make trading decisions. So think about it. If price trades down to a level and all of a sudden everyone and their brother comes in at that level and starts buying, okay, there's a strong tendency for that prices to stop at that level and reverse. And how can you tell when volume is strong? When there's strong volume appearing at a level, the obvious thing is the point of control. It's going to tell you that. It's again, it puts a box around the level in the bar where the point of control is. Now you see every bar has a box around it, right? Every bar has a point of control. Now there's certain points where it really means something. A lot of times it doesn't mean anything. I want to say doesn't mean anything, but isn't as important as something like this. This is a market that's going down, down, down. This red line is the low of the day. You get this bar down here in the corner. Hope you can see it. There's a box at the bottom, which indicates the point of control is at the bottom. That's where the most volume is. So you have this market, it's coming down. All of a sudden, the heaviest volume in this bar is right on the bottom, right on the low. In this case, it happens to be the low of the day. Now, again, the previous presenter, great guy, he even says, don't try to pick highs or lows. I'm not trying to pick highs or lows, but sometimes the market is screaming at you, say, hey, idiot, something's happening down here. Take a look at it. And if you're using an order flow chart, you can see that, right? So, what happens? Next bar up, next bar down, next bar up and then down, and the next bar up, and then what happens? We rally. We rally from 37.5 all the way up into the mid 40s. So that's at least a nice 7-point move. But the tell was right here. If you've ever played poker, everyone's always talking about, oh, he's got a tell. He scratched his nose or he rubbed his eye. That gave it away of what was going to happen next. And things like point of control in the order flow tells you what's going to happen next. And you talk about, everyone talks about, oh, you want to have low risk trades. Well, down here you have a lot of support. This is the market telling you, hey, there's support down here. If you get past this level, there's no more reason to be in the trade. So you could literally have a very, very, very tight stop, of just a couple of ticks. I'm not talking points, I'm talking ticks. If you get past this level, forget about it, get out. But, are you willing to risk a few ticks to catch, all these points? That's something you have to ask yourself. Now, when I'm talking about point of control being support or resistance, look at what's happening. If you can determine, that the market is turning, okay, what you would like to know in the next bar is, where can we retrace to? And, the bar goes up, goes down. And if there's a way you can determine where you're going to retrace to and then turn around, would that be worth something to you? Of course it would. So here you have point of control towards the bottom. It's not on the bottom, but, if one of the ways to look at it, that people look at it, is if it appears, towards the bottom, there is support there. Or if it appears towards the top of a red bar, there is resistance up there. So, once you stand out, once you say, okay, I think this is going to be a swing low, watch what happens. Okay, next bar up, you got point of control here. Where does this bar retraces back to that level? One tick through. Next bar, point of control here. Where do we trade? We trade within one tick of it. We get the swing high here. It changes. You've got a red candle. It's going down. Point of control up near the top, which again is a sign of a potential swing, a potential change in trend. You got your point of control up here. This next bar, what do? We trade right back up to that level, one tick through. And then all the way down, we're all below the point of control. We get within a couple ticks, get one tick through, and then we change again. So, it's market-generated information, and if you're a short-term trader, it's going to give you levels to trade around. Now, if you're using a normal candlestick chart or a bar chart, you're not going to see that information. Where is it on here? You're going to be saying, well, I see a green candle, it's going up, it closed higher than it opened, okay, it's changing trend. Yeah, is that analysis? In a basic level, but, wouldn't you rather know that, hey, I got all this buying down here. You don't see all this information necessarily down in there that you see, on the order flow chart. Wouldn't you rather get in on a move, as close to the low of it as possible rather than, somewhere up here when the move's already started? I think it's better to get in early rather than late. I'd rather get in early and risk a couple ticks to catch how many points rather than give up how many points and risk how many points, to get a few points. Risk ticks to get points. Risk as little as possible. Like I said earlier, I don't like risk. I don't like to take trades and have a mile wide stop. That's not what you want. You want to have as if a trade's not working out, recognize it, get out, move on, look for the next trade. That's how you're going to survive in the market. Number two, the second part of order flow I want to talk about today is delta. And what delta is, it's the net difference between buyers or sellers in a bar. And why is delta important? Well, because it will show you, one, who's in control of the market, and two, how strong they are in their control of the market. So let me ask you a question. For a market to move away from a high, what needs to happen? Are we going to move away from a high because the market's overbought, or because an oscillator crossed the zero line? No. Markets don't trade around oscillators. They don't trade because everyone thinks it's overbought, oversold. Like, again, in the previous presentation, he talked about how markets can go overbought, and still keep going higher. Every time you try to short it, at an overbought level, you're getting your head handed to you. So, again, markets move based on people's activities in the markets, people's perception of where price is going, and that's all translated into the order flow. What they're actually committing to the market. Are they buying? Are they selling? So, to move away from a high, you need basically, you need several things, but the top three are, you need net buying to decrease, right? As you're going higher, buying generally will lessen as everybody has been satisfying their need to buy, okay? And finally, the last person will have bought, and then there's no more buyers. That's one way prices drop, right? When there's nobody left buying it, what's going to happen to the market? Price is going to go down. That's natural. Then, the second thing is, obviously, you need sellers. You need sellers taking control of the market, sellers that have a lot of inventory that they want to unload and sell to the buyers. And most important thing is you need sellers to dominate the market. You don't want buyers matched up evenly. You want sellers to be in control. You want all the people coming in buying, but the sellers up there knowing in the back of their mind, hey, I up at this level I could sell all day, right? Who are these sellers? They're the big institutions, or the big commodity trading companies that have inventory, or know that they're going to be harvesting a bumper crop of corn, or soybeans. Those are the people that will come in and offer the market lower. So where is delta on an order flow chart? Delta is a number at the bottom. You could have it on some software. You could get it printed, above or below the bar. But in general, it appears along the bottom. Most software has it along the bottom, and it's going to be a number. It's going to be positive or negative. Positive will be a green color. Negative will be a red color. So at a high, question you should always be asking when you're at a high is this high going to hold, or we're going to go sideways? We're going to sell off? What's going to happen? So it's a perfect example. We're going high. You have positive delta. That's what you want to see when you're going higher. Positive delta going higher, right? There's more buyers than sellers, net buyers than sellers. There are times like you could have sellers come up, but that's a more advanced theory, which I don't have time to get into today. But at a basic level, when you're at a high, you want to see positive deltas. You don't want to see so many negative deltas. Now, I talked earlier, there's different types of strengths. So you're at a high here. You got delta of 421, but the next bar, the delta is negative, minus 4,000. So there's a lot of sellers in there. Okay. Next bar, 22. It's kind of small. Next bar, 600. 300, minus 200, positive 400. So, kind of mixed, smallish. And then again, minus 2,000, minus 1,000, minus 1,400. So you get this period in here where you get a lot of sellers coming in. Okay. Market's just going sideways. Positive 1,500, small again, minus 59, minus 1,100. So, what's happening up here? Well, it's kind of mixed, but it's a bit slanted to more sellers. You pop up, you get sellers come in. You pop back up, more sellers come in. Now you're starting to pop back up. What's going to happen? Here's minus 4,000. Where in here do you see a positive 4,000? You see another negative 2,000, negative 1,000, and negative 1,400. So you're seeing a lot of selling, coming in. It doesn't all come in at once. People come and sell it. They test the market, right? That's what institutional traders do. They've got a big position. They're just not going to dump it all at once. They're going to see what the market could accept, back off, wait for it to come back up, sell some more. That's how they trade. I did it for 20 years, so I'm very familiar with it. And what happened next? This is just a continuation up here, right? This is where we ended. 59.1136. So 59.1136 minus 2,000 minus 1,000, and then it just falls over, trades down all into new lows. So when you're at highs or at lows, watch the delta, keep an eye on it, see what's happening. Are there net buyers or net sellers? Is it strong? Is it weak? Why are there futures markets, forex markets, stock markets? They exist to transfer risk from one party to another. Where does this occur? It occurs at a price where a fair price, a level of perceived value. The market's purpose is to find value. It's the price level where both buyers and sellers are happy to trade with each other. And, at those levels, you're going to have small deltas because buyers and sellers are going to be evenly matched. So when you start seeing, deltas contracting, getting, to relatively small numbers, a delta of 50 in most markets is a difference of one trade. People buy and sell 50 lots like water. So, just keep an eye on it, and it's going to give you a lot of information. Sometimes it's not going to tell you anything other than, hey, the market's doing what it's supposed to do. It's facilitating trade. But there's times where things just really stand out and jump up and bite you in the rear and say, hey, look at this, don't miss this. So when a trend starts, it's going to do it because the market is leaving from a current value area, going to look for a new value area. So again, the market exists to find a level where people are happy to transact. So once everyone's happy transacting at one level, okay, the market fluctuates, it fluctuates. People's ideas of where the market's going to be in the future change, and then the market starts moving, right? That's how trends happen. It goes looking for its next value level where it can trade a lot of volume. Now, delta is a tool that order flow traders use to determine the strength of buyers or sellers in the market at any given point in time. It's either going to be a positive delta or a negative delta. Positive delta indicates buyers are in control of the bar. Negative delta indicates sellers are in control. But the key is to realize there's different strengths of delta. I don't want to use the term delta neutral, so I'm using neutral delta, which means a small delta, which more or less, one or two trades can change the delta. Average delta, strong delta, and extremely strong delta. So, it's best to look at examples, honestly. And when you see, I'll say enough of them, when you see a lot of them, you understand what I'm talking about. And, again, this is example here. We're at our highs. The green line is the high of the day. And what do you see? You're at your high, you got negative delta. Next bar, negative delta. Next bar, negative delta. And then it pops back up here. If you're not convinced already that, hey, we're at this high level and we could start to sell off, because sellers are now in control of this market. There's very little buying, net buying, and there is buying, but it's still being crushed by the sellers. You get short in here, and you got a nice move down. This bar here has got a delta of 14, which is what I call the neutral delta. 14 lots is nothing. I'll say nothing, but it could go either way from positive to negative, in one trade easily. And certain markets, S&Ps, probably be 200 lots. Crude, 50 lots. Each market's a little bit different. Now, there's going to be times, I said, it's either going to be positive or negative. There are times where it lands on zero, exactly zero in a bar. That's more of coincidence than anything else. It's got to land on a number, and sometimes it's going to be 1, sometimes it's going to be 0. It could be 157. I'll say it's random, but it depends on what's being traded in the bar. But there are times when it comes into 0, and there's nothing. I honestly, I've never found out anything special. There's no special secret when the delta is exactly 0 in a bar. All it does is just tells you buying and selling is evenly matched. So another example, watch the delta off a low. Anytime you're at highs or lows, watch the delta. If the market's trading sideways, watch the delta. You always want to be seeing, it's information that's available to you as a trader. Use it. And this is a perfect example. We're at the lows. watching the deltas. You come down here, we hit a low, still got negative delta, and then another negative delta. Okay, you know what, we're still at the lows. Maybe the selling's not done yet. Now all of a sudden we start to rally. Positive delta 2000, positive delta 2000, positive delta 2000, and then 74, 1400. Okay, maybe some selling is starting to come in. This buying was short-lived. You don't know. I mean, we'll see how it unfolds. Then you watch the next bar, you hit the low, you touch the low, you got a double bottom. People say, well, it's a double bottom, you should be buying. Well, double bottoms fail about as often as they work. So what's interesting this time that you don't have the first time is you have a positive delta. Oh, it's still small. It could change very easily. Then the next bar, what do you got? You got strong positive delta, 1600 again. So similar to what you had here, you have, you hit the low, bounce up a little bit, and then you got strong positive deltas. Okay, watch. 1600, 3000. Okay, you're thinking, hey, maybe I want to make sure we're going to take out this previous swing high here. And you do. You got strong positive delta. So, even if you're getting in here or here, in this last bar, what happens? This is the third bar there. This is right here. 2483. 2483 is this bar. So even if you get in really late up here, you still got this nice move from 24 and a half all the way up, all the way up to 28 at least, and you went from the lows straight up to the highs. Now, not every example is going to be as picture perfect as that. I don't even consider this picture perfect. I could have put much more picture perfect. It would have been picture perfect without these three down bars. But nevertheless, what you really want to be looking at is how the market is acting, at highs or lows. If it's starting to put in string together periods with positive delta, that's often a sign that, hey, buying is coming in. People are starting to accumulate down here. The market's all about accumulation and distribution of positions. So, when you start looking at delta in relation to the market, especially over several bars or in certain areas, highs or lows, it becomes clear what the market is telling you. And all this information is there. It's available to traders. It's not like you got to subscribe to extra data feeds. Level 1 data, if you have it. Now, again, I'm a futures guy. I don't trade Forex. I don't trade stocks. I've always been in futures since I started in this business, and everything that I apply applies to futures. The data is much more pure, I find it, in the sense that it comes from one centralized exchange. It's not coming from different exchanges, different pools, or brokers that are, I'll say, bucketing the trades. But Forex, you could have one quote at Barclays and another quote at Deutsche Bank, and then you got your quote on your screen, which oftentimes, if you're trying to trade intraday, it can be a headache. But the third thing I want to talk about is imbalances. And imbalances, they highlight when one side of the market is starting to show its strength. And by definition, what is an imbalance? It's the state or condition lacking balance. Yeah, obviously, as in proportion or distribution. Okay, so how does that translate into order flow? Well, markets are two-way auctions. There's a bid, there's an offer. Okay, and you compare, what's on the bid price to what's on the offer price. You want to buy it, you got to pay the offer. If you want to buy it now. If you want to sell it now, you got to sell it at the bid. You could work a bid, you could work an offer, but you're not going to necessarily guarantee you're going to get filled. And when it trades on the bid, it shows up on the order flow on the left-hand side of a bar, the bid side. If it trades on the offer, because the software, it reads this information, and it prints it out there for everybody to see. It'll show it up on the offer side of the volume footprint. That's the beauty of using an order flow chart, is you can get that information and not manipulate it, but you have that information and it puts it into an easy to read and easy to understand format. So there's basically four types of market activity. There's passive buying is when you work a bid, you try to buy the bid price. Passive selling is when you try to sell at the offer price. You have your price in mind that you want to sell it at, and you're happy to sell it there. If you don't sell it, you take that chance. Aggressive buying is when you buy at the offer price. You want it, you have to have it, you pay the market price. In other words, a market order. Aggressive selling, you sell at the bid price. You're selling at the market. So it's important to know what kind of buying or selling is occurring. Now, it's confusing for people sometimes to wrap their head around, aggressive buyers, passive buyers, but put it in everyday terms. We all deal with order flow in everyday terms, and best way to describe it is, you want to sell your house, right? You want to get as much money out of it as possible. So you have a price you want to sell your house at, $500,000. Okay, so you put it out there on the market. You want to sell it for $500,000. That's the offer price. Of course, you want to do it when there's hungry buyers, when buyers are aggressive and are willing to pay your offer price. Because if the buyer buys it at your offer price, he's the aggressive buyer, he's paying the market price, you are the passive seller. Now, if you put it out there at a time when everybody else is selling their house and there's a lot of construction, there's going to be a lot of traffic, so everyone's, I got to get out of this neighborhood. And there's buyers that, yeah, I like your house, but I don't think it's worth $500,000. I'll work a bid. 400 is my price. So he counter offers you. He bids 400,000. You all of a sudden got to make a decision. Do I hit his bid? Do I sell it at the market price of $400,000 and be done with it? So if you decide to do that, you're the aggressive seller because you're going to his price. He's the passive buyer. He could take it or leave it. If he gets filled, okay. If he doesn't get filled, okay. He's happy to wait for the market to come to him. He's being passive. So, there's always going to be, in every transaction, there's always going to be a passive buyer and a aggressive, there's always going to be, passive buyers, passive sellers, aggressive buyers, or aggressive sellers. And, they're all going to be matched up one way or another. So, in the market, an imbalance will show up in the order flow when there's a higher percentage traded on the bid against the offer or vice versa. So on an order flow chart, there's black numbers, there's blue numbers, and there's red numbers. Red numbers indicate a selling imbalance. So 12 against 686 here at the top of this bar, it indicates that there was more aggressive sellers. There's 686 traded into the bid. People sold 686 lots into that bid. And 12 lots were bought at the offer of 2371. So you have an imbalance, 686 against 12, right? You're comparing that number, that relationship. And for order flow, you could use whatever percentage you want, but the industry standard seems to be about 400. There's people that just look at, say, 1,000% imbalances, okay, which is 10 to 1, and they have trading strategies built around that. And here, 2370.5 against 2370 and 3/4, 89 against 1092. So you have a buying imbalance. This blue number indicates a buying imbalance, right? Now, if you're just looking at a normal bar chart, this is a candlestick chart. People used to always say, oh, candlesticks are order flow. Not really. But why limit yourself to this when you could have, all this other information? It's just tools, right? I mean, it's tools. It's not some fancy holy grail green light trading system. No, it's tools. As a trader, you have to make the decisions. Do you buy or do you sell? So at a basic level, imbalances tell you the general nature of the market, right? You expect to see buying imbalances as markets move higher, selling imbalances as markets move lower. Common stuff, right? But if you're not using order flow, you're not seeing it. So, it's like you're leaving a very easy way to analyze what's going on in the market. Lots of times the market goes sideways, right? And you don't know, is the market showing strength? Is it showing weakness? Are we going to start breaking out? Are we going to start breaking down? If you're looking at something as simple as market imbalances, you can see this information and you can make a better trading decision. The last thing you want to do is take a position and then the market goes against you, right? But if you could take a position, a more intelligent trade, based on the information at hand, then it's going to put you ahead of everybody else that's not using that information. So ask yourself, what would it be worth to you to know when you're at a high that there's more aggressive selling going on than aggressive buying, right? You're at your high, but then all of a sudden you're seeing aggressive selling coming in. That's a sign that the high is probably not going to hold. Now, if you're at a high and you see spurts of aggressive buying, chances are you could see another pop up higher. So would you want to know that? Well, I think you should. When the passive buying at higher price level is satisfied, you have no more buyers, and also you got a lot of sellers. What's the market going to do? It's going to sell off. That's not rocket science. People tend to think that the more complicated to make trading, the better they'll be. But all they do is it ends up just shooting themselves in the foot. So buying imbalances are the blue numbers inside the bar. You can see here blue, blue, blue. Selling imbalances are red numbers inside the bar. Red, red, red. Don't worry about these above or below the bars. That's something else. I won't be talking about that today, but if you go to my website, you can learn everything you want to learn about those. But as the market's going down, you see selling imbalances. You see sellers in control. On a market that's going up, you see buying imbalances. Buyers are in control. You're going down, more reds. Going back up, more blues. Going back down, more reds. Yeah, it sounds simple, right? That anybody could do it, but people don't look at this information, and it's just sometimes just bang my head against the wall. Like I said, people try to make things more complicated, and in the end, they just shoot themselves in the foot. So look at this. This green line is the high of the day. I always like to know where the highs and lows are for the day, so it gives me something to trade around. And at your highs, all of a sudden you see a lot of selling imbalances, 1, 2, 3, 4, quite big, 8,000, 1,200. Yeah, you got a buying imbalance here, again, some more selling, come back up, you know, selling imbalance, selling imbalance. But what do you think is going to be happening? You're at your high, you've got a lot of selling. Markets tend to sell off. Again, another perfect example. Right, we hit a high, got negative delta. Okay, that's already something up there that should already get your ears pricked. Okay, hey, I just hit a high, I've got negative delta. Then all of a sudden, what do you see? You start seeing a lot of selling imbalances. 1, 2, 3, 4, 5. Okay, we got one buying imbalance, here, one back here before you made the high. But overall, you got all negative deltas for the most part. This one 400, it's a bit small. But then you got, you throw in the selling imbalances. You can be fairly confident that we're not going to go back up and start making new highs. Again, I'm not trying to pick highs or lows. What I'm doing is I'm reacting to highs and lows and saying, hey, I can make a fairly confident trade, getting short somewhere in here around 77 that, we could be trading lower. We go from 77 all the way down into the low 70s, 72, 71 there. Now, this is more of an advanced concept that I'm not going to be talking about, but take imbalances further, stacked imbalances. You have multiple imbalances stacked on each other. They often act as support in the market. And again, it's another market-generated level. And again, watch what the market is telling you. Again, another high. E-minis, boom, 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 high, buying imbalances, buying imbalances. You hit the high, negative deltas all up in here. These 4 bars, 5 bars, all negative delta. Look at this, all the selling imbalances. Again, you can be fairly confident that we're probably going to move away from this high. And we do. Trap traders, I'm not going to talk about. I hate the term trap traders. I think it's a buzzword that people use. But one of the things you can look at is imbalances at extremes of bars. They have meanings. People are stuck in a position. They're going to get out. 116, 300, 400. Yeah, these guys are long and wrong at the high. They're going to have to get out. Not necessarily everybody's going to get out right at the same, and they're not all going to run to the exit at the same time. But the software that I have, will actually highlight these imbalances at the highs of the bars. So, I'm not going to spend much time on trap traders, but imbalances in certain situations at extremes of bars are very important and lead to very good short-term trades. So, hopefully by now you can see how powerful order flow analysis that is. Is it easy or difficult? I showed you 3 basic concepts that you could build trading strategies around. You go from there. Keep it simple, right? That's what you have to do in trading. Keep it simple. An order flow is about as simple as it gets. Again, people think it's very complicated. It's really not. I hate to use the term common sense, but we all use order flow in our everyday lives. You go to buy a car, right? You know what you want to pay for the car. The car salesman has what he wants to sell it to at. You guys are going to have a 2-way auction. You're going to either go up in your price, he's going to come down. Maybe you guys meet in the middle. That's a form of order flow. And this really, I think, is the easiest and fastest way to trade with order flow is use those 3 basics, delta, imbalances, and point of control. That will help you make you become a consistent trader and give you control of your trading, right? I mean, the worst thing you do is take trades based off some indicator that you don't necessarily understand. When you're using order flow, it's not based on luck or some special thing. It's understanding what's happening in the market, and then all of a sudden, the market makes sense. But let me be clear: you have to make trading decisions. That's what trading's about. The order flow is not a red light, green light system. At the end of the day, you have to make the trading decisions. But I do think order flow makes it very easy to find hidden strength or weaknesses in the market, determine if highs or lows may hold, and use market-generated support or resistance levels that you're only going to get with order flow. So, again, without spending 10,000 hours of screen time, without taking unnecessary risks, and most importantly, without wasting your money, throwing it down the toilet, basically, trying to find something that works, you know, learn how to trade. And the best way is to learn what's going on in the markets. And I do think, order flow, I mean, I'm a bit partial, but I've literally been trading futures for 20 years. I started on the floor, and you don't get successful. You don't last for 20 years. You definitely don't last at a firm like J.P. Morgan for very long if you're not successful. I know guys, we hired guys that traded at Tudor. They only lasted 2 years. I was there much longer than them. So if you're ready to see how to do this for yourself, let me know. Type yes. I want to work with people that want to understand trading, that want to become traders. And what I have, honestly, I'll be lay it out. I do have a software. You don't have to use my software. I do think mine is one of the better ones out there. I say better, but as affordable as well. I mean, people out there, you can get it for $100. Some software for $100. You get some software for $5,000. There's a lot of room in there. I mean, I think one person sells it for $10,000. Runs on NinjaTrader 7 or 8. And I have a Sierra Charts version. Email me. I'll send you details of where to go on that. It's a volume footprint chart, but what makes mine different, right? I've got 4 pre-programmed order flow indicators in there that's not available. Well, one person, I take that back. One person copied one of my ideas and put it in his software, but I was the originator. And I also give you my chart template, so you're not lost. The worst thing you can do is buy software, not know how to use it because it takes too long to set up. So having order flow software is one thing. The next thing is knowing how to use it. And I don't just give you the software, I send you on your way. No, I have tons of education. Don't say tons, I don't want to scare you away, but I do provide extra training, extra education that's there if you want it. Not everybody takes advantage of it, but I have a 20 lesson trading course on order flow. And it's 15 hours of videos. You can watch whenever you want. You don't have to watch it in one day. You can watch it over 2 weeks. So it's always available for you. Normally I sell it for $297. Every day I sell copies, $297. I'm giving it to you with my software package. Now, the other big thing, which I don't offer to the general public, is my trading room. I used to offer it. I used to sell access to it for $299 a month. It's free for everybody that uses my software. Whether you use the room for 1 day or you use it for 1 year, I don't charge you for it. You get it for free. You can go there, ask me questions, whatever. It doesn't run every day. It's Tuesday, Wednesday, Thursdays from 8 a.m. until 10 a.m. Chicago time. And I look at E-minis, bonds, 5 years, and maybe some overnight markets. But I give you access to that, and there's archives that go back for a year on that. So again, normally I sell my software. Just the software by itself is $899. The course $297. The trading room, $299. That's just for a month. Use it for a year. That's $3,000. Together, that's just $1,400. But because of this presentation with investor, they've been very nice in inviting me on here. I do want to make it a little bit more worth your while. I have a special offer. I'm throwing in. I have this new indicator set, 3 order flow indicators. If you're interested, take a look on my website. I sell this set for $650. If you buy through this webinar, it's free. Okay, simple. I'm not asking for any more money, but it's just for this webinar only. It's going to expire in 48 hours. So if you don't get the software package within 48 hours, sorry, that's it. But add that all up. That's over $2,000. Okay, and I'm not going to charge you anywhere near that. Just a one-time payment. That's it. I don't ask for keep coming out, give me more money, give me more money. No, it's just a one-time payment, $999. I'll say. There's no other payments. It means you have to pay for your data fees. I don't get that. In your NinjaTrader fees or Sierra Charts fees. I mean, depending on who your broker is, maybe you get it for free. But other people got this. And it's made big differences in their trading. As Ziad says, people that don't see the value on what you're sharing are simply missing the point. The positives that put on the table are massive for any trader, willing to learn trading as a career. So put it in perspective, $1,000, you can buy you could buy an iPhone. Okay, great. In 2 years you could buy another one, and you still won't be a better trader. That's what are you going to do? You want to become a better trader or not? So go to the website, orderflows.com. Renee's put it in the chat box. You just go there. This is the website. Scroll down. and you come down in here, NinjaTrader 8, NinjaTrader 7, choose the one that you want, and act on it. So in the beginning, I said, if you want a free copy of my book, email me, Mike at Orderflows. Send me your book, and just put that in the subject line so I'll know you're after it, and I'll flip it out to you. Now, again, I'm just a normal person. I started at the bottom in this industry. I literally was working another job. When I got out of college, I worked in a grocery store, period. Because I worked, that's how paid my way through college, is I worked in grocery stores. I got out, didn't know what I want to do. Someone said, hey, you want to manage this grocery store? Oh, okay. But, I decided, that's not what I want to do with my life. There's nothing wrong with working in a grocery store. You could have a very good life. I still have friends that work there. And, but I wanted more. I wanted more out of life. So I took the chance. I went and started at the bottom. Now you can't start at the bottom. You can't go down to the exchange. You can't become a runner. Where are you going to start? You trade yourself? No. You need some sort of structured training, and a method to trade. And that's why I put together this package. And, I do think that you get this package, work with me, go to the trading room, to the education, and, you'll be light years ahead of everybody.